Friends, the last session was closed with a small mistake that it is 1,40,000. Many of you have texted me. Instead of 10 lakhs, I had put 1 lakh. So it's 1,40,000, 145,600. Okay. I've corrected that mistake. Thanks to people who pointed out. We will focus on some of the income heads which has few amendments. Income heads which has amendments. In salaries chapter, okay, amongst the amendments, ESOP is going to be the major amendment, okay, but the other amendment, smaller amendment is there is a cap on the total contribution employer can make. இப்போ ரெகுலராகவே ஒரு கேப் இருக்கு. For example, pension fund 10% we add whatever contributed and less only 10%. PF up to 12% only employer can contribute. Superannuation fund up to 5 lakhs there is okay. But there is now going to be an overall cap also on all these things. Aggregate amount of contribution by the employer. Remember, it is by the employer to RPF, National Pension Fund, Superannuation Fund, and annual accretion. அதாவது இங்க இதோடைய interest, okay, to the balance of the forfeit fund is restricted to 7,50,000. All funds put together, it is restricted to 7,50,000. In other words, where the aggregate contribution exceeds 7,50,000, then such excess is taxable in the hands of employees. ரொம்ப high level employees this will have an impact because 12% of PF, 10 per salary and 10% exceeding 7,50,000 all put together will be the salary of that employee will be very high, probably to that higher sector. This is, but there is an overall restriction of 7,50,000 to all the funds put together only for employers' contribution. Employees, no issues. They can continue to enjoy. Only for employers' contribution, this is there. Okay. And now I am going to one of the major amendment, okay, that is in terms of ESOP. Give me your ears for some time to talk about ESOP. ESOP, employee stock option or sweat equity shares, is given to an employee by the company, okay, at a concessional rate, sometimes nil or at concessional rate, to motivate the employee to be part of the management. Okay, so in our salaries chapter, section 17 treats it as a perquisite. Section 17 treats it as a perquisite. The difference between, please understand, the difference between FMV on the date of exercising the option. In a date, exercising the option. Okay, FMV on the date of exercising the option and the actual consideration paid will be treated as perquisite and taxable in the year in which the option is exercised. Okay. Ipo, there are many startups which are emerging. We see a lot of startups. Okay. A few years back, we know how Freshworks was. Today, how it is. Open book. Okay. Like this, many startups are coming into. They want qualitative employees. So, they offer ESOP to them. Okay, they want qualitative employees, ESOP. ESOP now, and the employee, you are part of, you are the owner of the company. Okay, so they want to retain that employee because he is a very qualitative, very competent employee. I cannot match his salary levels if he goes outside. So instead, I give him the benefit of ESOP to retain him. In the ESOP, it's a perquisite. What is a perquisite? Perquisite is non-monetary benefit, RFA, concessional loans, asset transfer, like that, non-monetary benefit. Now, okay, if I am the employee, if the company gives me shares, it is not monetary for me. Tax I need to pay tax for that. A non-monetary benefit received by me, but monetary outflow is there, and the quantum can also be very huge. So these employees are left without option. If I choose to join a startup where they are offering me ESOP, the biggest problem I have is, even though there is no receipt of money, but there is an outflow of tax. To benefit them, this amendment is made. They say, boss, pay the tax after 5 years. Any startup, which is a landmark amendment in income tax law, any startup which is providing ESOP to employees, any startup which is providing ESOP to employees, they can pay the tax even after 5 years. Let me go slow on this. Normally, taxation of sweat arises in the year in which option is exercised. Normally, இதுதான் normal provision, okay, for all employees. In the year in which the option is exercised, the tax arises. Finance Act 2020 has given relief to employees of eligible startup. Eligible startup na 80 IAC. They will qualify under 80 IAC. Turnover will be less than 100 crores. Technological sector la IMBC, Interministerial Board, will certify them, okay, like that, okay, 80 IAC, where 100% of their profits are going to be exempt, okay, deduction, allowed as deduction, we'll see it later. But now, eligible startup is one which is referred to 80 IAC. In case of employees of eligible startup to whom ESOP allotted, perquisite is taxable in which year? After the expiry of 48 months from the end of relevant assessment year. என்ன சார் 5 years சொன்னீங்க? I'm still holding. After the end of relevant assessment year. So, in terms of previous year, it is 5 years. In terms of previous year, sir, you are allotting me this year, today, sir. For example, okay, it is not 2021. Today, you are allotting me in the year 21-22. I know it is not falling in your previous year, but for example, in the year 21-22, you are allotting me. Assessment year 22-23. Assessment year ends in 27. So from today, 5 years is there for me to pay that tax. After the expiry of 48 months from the end of the relevant assessment year, or in the year of sale of such securities, whatever I received at ESOP, if I sell it, or in the year of leaving employment, whichever is earlier. So, for an employee of a eligible startup to whom ESOP, sweat equity shares are given, taxation arises 5 years after the year of allotment, at the time of leaving employment, at the time of sale of shares, whichever is earlier. Okay, so there is a big benefit that is provided by the tax law, that you need not pay the tax now. You need not pay the tax now. You can pay the tax later. Now, திருப்பி சொல்றேன், because this is very important to understand. You need not pay the tax now. I am not saying, or the tax law is not saying, that this is not your current year's income. It is your current year's income. It is your current year's income. But the tax for that income can be paid later. I'll tell you this point, you remember. In other words, there is deferment of tax of such perquisite for employees. They are required to pay only after 5 years. However, if they sell or leave before that 5 years, then in the year of selling or leaving, perquisite will be computed and taxed. Point to remember, only taxation is deferred, not computation. இதுதான் நான் சொன்னேன். Remember, it is current year's income. Income in the year in which option is excised, that is not changing. Only the tax for that can be deferred. In other words, tax will be computed at the rate prevailing in the year of excise of option, and the same will be paid after 5 years. Okay, ma? After 5 years, probably your tax rate might be, peak rate might be, instead of 30%, 25%. Or your basic exemption limit instead of 250 might be 5 lakhs. I am not allowing you to enjoy that benefit. In that year, include it as income and compute the tax of that year. In this year, in the year in which you are excising the option, you will include it as income. But the tax on that you need not pay it. Now the tax can be paid 5 years. Consequential amendment to this effect is also made in TDS provision. Section 191, section 192. When we read TDS, I will again recollect this provision. Can I quickly recollect? This is only for employees of an eligible startup. Eligible startup means that which qualifies under 80 IAC. To make 80 IAC a quick reminder, it should be a technology-based company. IMBC should have approved it, and the turnover should not exceed 100 crores. Like that, the provisions are there. I will come to that later also once. So it should be a company of 80, it should be an entity of 80 IAC, eligible startup, in which the employee is allotted sweat equity shares. In that case, the tax on income, the tax on the sweat equity shares can be paid 5 years after allotment, or at the time of leaving employment, or at the time of sale of such sweat equity shares, whichever is earlier. Consequential amendments are also made wherever necessary. Okay. An opportunity was taken to just explain what is the meaning of fair market value of shares and securities. Okay, depends upon listed or unlisted or where. Okay, meaning this is because we say that difference between fair market value and the money paid is known as perquisite. We say perquisite value is equal to FMV minus consideration paid. So what is that FMV? Since FMV on the date of excising option is the perquisite value, it is important to understand as to what is FMV or how it is computed. In the case of listed shares, average price of opening and closing. Average of opening and closing. Sir, ரெண்டு ஸ்டாக் எக்ஸ்சேஞ்ச்ல ட்ரேட் ஆகுது. NSE, BSE ரெண்டுத்துலயும் ட்ரேட் ஆகுது. Wherever the trading is higher, take opening and closing. Sir, ரெண்டுத்துலயும் ட்ரேடிங்கே இல்ல. Whatever is the last preceding date in which trading happened, take the opening and closing. Average of opening and closing price of share listed on the date of exercising the option. If shares are not traded, then closest to that date. Where shares are listed in more than one stock exchange, then wherever the highest volume of trading happen, அதோடைய average எடுத்துக்கணும். Okay, shall I repeat? In the case of listed shares, average of opening and closing will be taken as fair market value. Where there is no trading on the date of exercising option, just look back and see whenever was the last trading, take that date. Where on that date the trading was there, but not only in NSE but also in BSE, wherever the trading volume is higher, take that average. Okay. In the case of unlisted shares, as we know, that is the merchant banker should certify. Okay, and if he has already certified once at 180 days has not lapsed, take that. Okay, value determined by the SEBI registered merchant banker on the date of exercising the option, or a date not more than 180 days earlier to that date of exercising the option. Read through once. We'll do one of the questions and see. Question number 1. Arjun is employed in Kantip Limited, a company which is recognized as an eligible startup. Basic salary for the year, HRA 50% and rent paid in Chennai 35,000. He as well as the employer contributes 10% towards pension scheme. Company allot him 10,000 equity shares on 1st January. The value arrived at that time is 790 per share. Compute his total income and tax. Also compute the optional tax regime. I want to work out optional tax regime in a couple of questions so that you get the grip. In which year the sweat equity shares are taxable and what is the quantum? Suppose if Arjun leaves on 1st June 2023, how does the working undergo a change? Working will never undergo a change. And the year tax pay pannu. That's all. Working will not undergo a change because I am not including it in the year in which you are paying the tax. I am including it in the year in which option is exercised. Okay. Computation of total income. Rent paid in Chennai is 35,000. So 7 lakhs minus 2 lakh 80,000, 4 lakh 20,000. Employer contribution to pension fund. Okay, 14 lakhs into 10%, 1 lakh 40,000. Employer contribution to pension fund. The company allots him 10,000 sweat equity shares. Perquisite value of ESOP. Perquisite value of ESOP 10,000 into 790. 10,000 into 790. $79 lakhs. 79 lakhs. Deduction under chapter 6A. Okay. Employees contribution to pension fund 80 CCD part 1. Okay, restricted to 10%. Anyhow, 10% is only contributed, so no problem. Whereas here you cannot claim it. Whereas here you cannot claim it. Employees contribution to pension fund. Okay. Then comes employers contribution to pension fund. This is 80 CCD part 2 or subsection 2. It is also restricted to 10%. In this question, no problem. Okay. In this question, no problem. Okay. 1,40,000. This you can claim in optional tax regime also. Total income. Total income 9580 and 1 crore. Computation of tax. First, compute tax in our normal manner. Base tax. Base tax. Okay. 95 lakh 80,000 minus 10 lakhs into 30% plus 1 lakh 12,500. That is 85 lakh 80,000. 85 lakh 80,000, okay, into 30% plus 1 lakh 12,500. இங்க, okay, இங்க 1 crore minus 15 lakhs into 30% plus 187,500. 1 crore 1 crore minus 15 lakhs, okay, into 30%, 85 lakh into 30% plus 187,500, okay, and surcharge at the rate of 10%. That is also not exceeding 1 crore, so no problem, into 10%. And HEC at the rate of 4%. Okay. I'm working optional tax regime just for your comfort zone. Just that you should. இதுக்கெல்லாம் நான் இங்கேயே க்ளோஸ் பண்ணிடலாம். Optional tax regime is not going to be useful. Okay. So I would have closed there itself. Just for your comfort zone, I'm working it. Okay. And not anything else. Optional tax regime is closed. Okay, we are only worried about normal tax. Okay, now all of us concentrate, normal tax payable in the financial year 2021. Okay, normal tax deferred, normal tax deferred. Okay, 30 lakh 73,356. 30 lakhs 73,356 divided by 95 lakh 80,000 into 79 lakhs. Repeating, my dear friends. Okay. This is the tax which is deferred. That is 30 lakh 73,000 is for 95 lakh 80,000. What is the tax for 79 lakhs? I am repeating this point because only tax is deferred. Only tax is deferred. Computation over. The computation, if you take it after 5 years, that year basic exemption might be different. That year exemptions might be different. That year peak rate might also be different. I don't want surcharge might be there or might not be there, but very uncertain. Okay, so I don't want to do that. I don't want to do that. Now my normal tax will be difference between these two. Normal tax payable in the financial year 2021 is this. Normal tax deferred, okay, is this. Deferred to what year? I don't know. It can be 5 years or before the sale of, or at the time of sale or at the time of leaving employment, whichever. But this amount is computed and kept apart. நானும் compute பண்ணுவேன், my employer also computes and kept apart. The consequential amendment is made in TDS provision. Consequential amendment is made in TDS provision, where employer is obliged to deduct tax at source at the end of 5 years or at the time of leaving employment or at the time of selling of shares. So both me as well as my employer will compute my tax and set it apart. Keep it ready. This will not be deducted. Only this is allowed to be paid, or only this is liable to be paid or deducted as tax in this current year from his salary income. This will be deferred. அதனால தான் where we are being repeatedly saying only taxation is deferred, computation is already over. In your notebook, you can take this after this also, if you are more, if you want to be more clear. Okay. Okay. In which year sweat equity share is payable? What is the quantum? Quantum is there. This. Okay. Uh, Tax on sweat equity shares is payable 5 in the financial year. Now we are in 2021, 21-22, 22-23, 23-24, 24-25, 25-26. 25-26 or at the time of leaving employment or at the time of sale of these shares, whichever is earlier. Tax on sweat equity shares, this 25, 34, 7, 396. The consequential amendment is also there in TDS. TDS so appadan direct பண்ணுவேன். Okay, is at the time of leaving employment, at the time of sale, or wait for 5 years. Okay, 2021 la இருக்கோமா, add 5, 25, 26 la we will deduct it. Suppose if Arjun leaves employment in the financial year 23-24, how does the working undergo a change? Okay. Part B, Arjun leaving employment. Okay. Working does not undergo any change. There is no change in the working. Working remains the same. The tax that is deferred will be either deducted or Arjun is liable to pay in the financial year 23-24. Okay, in the financial year 23-24. Working does not undergo any change because it is already computed. It is already computed and set apart than it ever. It is not that in financial year 23-24 you are going to include this 79 lakhs as the income of Arjun. No. No. Only the tax computation is deferred. Only the tax computation is deferred. Okay. Probably questionable area. Again, in revision, I will work out 1 or 2 questions so that getting more confidence and tediously. Question number 2. The basic salary of an employee amounts to 50 lakh. Employer and employee contributes 14% to RPF, 12% to pension fund, and employer contributes 4 lakhs to superannuation fund. Specified tax treatment. Very interesting question from the questionable angle, but interpretation we have to wait. ஒரு ஸ்டூடெண்டா படிக்கும்போது ரொம்ப இன்ட்ரெஸ்டிங்கா இருக்கும் அந்த கொஸ்டின். Question number 2. Okay. Basic salary and DA forming part. Basic salary and DA forming part 50 lakhs. 50 lakhs. Employer's contribution to PF at 14%. To PF at 14%. okay, into 14%. To pension fund at 12%. To pension fund at 12%. To superannuation fund. To superannuation fund 4 lakhs. Total contribution less maximum contribution allowed from financial year 2021 is 7,50,000. Okay, therefore taxable perquisite will be 17 lakh minus 7,50,000 because the maximum contribution allowed is restricted to 7,50,000. ஆனா இதுல ஒரு ப்ராப்ளம் இருக்கு. என்ன ப்ராப்ளம்னா normally itself you would have taxed only 2% because provident fund எடுத்து பார்த்தா the provision says employees contribution will be part of basic salary. No, employers contribution allowed only to the extent of 12%. Allowed only to the extent of 12%. So you would have already taxed 2%. You should only take 12%. This is my interpretation. No clarification varla. But I am just telling you for your understanding. Provident fund in excess of 12% employer's contribution is taxable in the hands of employee. Already it is taxable as a perquisite. If I take 14%, employer contributes. In the 1 lakh is already included. Now it will be taxable as salary. Again, if you take 7 lakhs and reduce 7 lakh 50, it's not correct. Okay. Here also, you would have only allowed a 10% deduction. 12% you would have added. 10% only you would have given deduction. So, naturally, this should also be only 10%. And this can be for 4 lakhs. Okay. So, in my opinion, the future interpretation will say only 7,50,000 is taxable. This is for your understanding only. Alternate answer but as per law that stands today, this is the answer. As per law that stands today, this is the answer. Maybe you can write an answer, alternative answer like that, but questionable. I'm not saying this is reading the law as of now. Only 7,50,000 is allowed. Whatever is taxable in the law, contribution by the employer to all the fund, including the annual accretion, is restricted to 7,50,000. Anything above 7,50,000 will be taxable. So going by the law as of now, 9,50,000 is taxable. But my opinion is, I am also saying 950 is taxable because 1 lakh is already taxed. 1 lakh here also already taxed. Okay. Again, taxing 950 is like dually taxing the same income. Is like dually taxing the same income. So obviously the interpretation will come, is my opinion. This is only for your knowledge and not for your exam. Your exam, considering exam, take it as 9,50,000. If at all there is a question, it can be in objective type. Salary, 2 amendments. ESOP, the major amendment. Though minor amendment, this is not major. ESOP is the major amendment. Okay. Can be a theoretical question, can be a practical question. We will be getting ready for both. We know how to do. As I told you, in revision, I will do 1 or 2 questions to give you more that confidence. Now, I'm just introducing that. Okay, no amendments in PGB, the house property, that leads us to PGBP. That leads us to PGBP. I want to tell you, some of the amendment of PGBP is not due to Finance Act 2020. It is not due to Finance Act 2020. When the provision was introduced itself, they said it will be up to 31,320. It will be up to 31,3. Aதாவது with financial year 1920, those are over. So from financial year 2021, those are not applicable. We all know it, even in the year 1617 or 1718 itself. So these are not amendments of financial year, but I want you to understand those things also for 2 reasons. One, suppose some of us have studied it under the old provision, how the new provision is. For that purpose, I want you to understand to get the knowledge of it. Okay, to understand it. So, okay, friends. Provisions amendment not necessarily by FA 2020 but applicable from financial year 2021. First thing is section 32 additional depreciation. That still irukku. Enna sir, additional depreciation illaya irukku for loan entities located at notified area. Previously it was 35%, that has ended, which means even if the entity is located in the notified areas of the state of Bihar, West Bengal, Telangana, Andhra Pradesh, the depreciation they can claim is only 20% additional depreciation from 2021. They cannot enjoy the additional depreciation of 35%, which they were enjoying till financial year. I have not studied that. Please forget that. You can say it is 20%. Some of you might have studied that provision and come now. For them only I am addressing, saying that now it is only 20%. Similarly, investment allowance, which these entities, okay, located in the specific states were claiming, no more investment allowance is there. Hence, investment allowance cannot be claimed from financial year 2021. No more investment allowance is there. If you have not studied it, fine. Okay, if you have studied it, it is that you should forget it, which is easier than studying. So we will forget it. Okay, and the irony of life is okay, right? So investment relevance is not there. Then section 35, scientific research expenditure. Sir, is it withdrawn? No. This weighted deduction is withdrawn. Previously, 150% for manufacturing entities, external contribution for scientific research purposes to National Lab, Scientific Research Association, 150%, for companies whose main object is research, 120%, removed. From this year, only 100% can be claimed as deduction, be it capital expenditure except the cost of land. எங்கேயுமே land cost கிடையாது. We remember that cost of land can never be claimed as deduction. Lab, machinery, etc. Even if it is by a manufacturing entity, previously they were claiming 150%, now only 100%. One question I have devised exclusively to make you understand the difference. Okay, right? Only 100% can be claimed. 35 AD is made optional. Previously the wording was shall. Now they have worded this as may. Why? Because of 115 BAA, 115 BAB, 115 BAC. In all these cases, assessee has an option of alternative tax mechanism, optional tax regime. Anka, I cannot claim 35 AD. Shall I have to claim it. Okay, so they have changed it to May, which means assessee, if he wants, he can claim 35 AD, or he opts for optional tax regime. The depreciation claim don't allow any capital expenditure. Okay, the claim of capital expenditure for such business is made optional. Okay, இங்கே எழுதிடுறேன். However, depreciation can be claimed. And the capital expenditure depreciation can be claimed. This material will also be there in the drive, and I will also put it in our group. Agricultural extension program, that weighted deduction is gone, only 100% can be claimed. 100% can be claimed. Skill development program, only 100%, all over weighted deduction is gone. And இது already இது நம்ம படிச்சதுதான், but இருந்தாலும் prescribed modes of payment: credit card, debit card, net banking, IMPS, UPI, real-time transfers, okay, electronic transfers, and BMAP. Okay, we have studied this, but still I want you to, because everywhere now the law says prescribe more, prescribe more, prescribe more, so you can have it. 43CA, I will take it separately. Along with 50C, I will take it. Tolerance limit is increased by from 5% to 10%. Other than, don't worry about much about it. So these are all the changes except 43CA, which changes law Finance Act 20. The changes have been there. They have said that it is applicable only till 31/3/2020. Suppose we have studied the provisions previously, when we have worked out a question 150, 115 work பண்ணுவோம். இனிமே அது 100, 100. We should work it out 100, 100 only. Quick brush through. The main amendment of GBP is this mandatory audit of accounts. Okay, mandatory audit of accounts, which is again amended by Finance Act 2021. Okay, normally when there is an amendment subsequently, they will not question. Okay. In the case of assessee carrying on business, profession is same 50 lakhs remain. This is only for business assessees. The turnover limit for tax audit will be 1 crore. If where the turnover exceeds 1 crore during the previous year, audit is mandatory. But there is an exception. However, the turnover limit will be 5 crores. The turnover limit will be 5 crores. Okay? In what cases? Where aggregate of all amount received. Remember these wordings. It is not aggregate turnover. Aggregate of all amount received, including amount received for sales, gross receipts during the previous year in cash, does not exceed 5% of the said amount. So, cash collection should not exceed 5%. Cash collection should not exceed 5%. Similarly, okay, cash payment should not exceed 5%. Cash payment should not exceed 5%. Aggregate of all payment. Okay. Now this has been made as 10% from this year. Okay. So 5% or 10% as the case may be. Okay, it is aggregate of all amount received, aggregate of all payment. Adila cash payment பார்க்கணும். If it is less than 5%, then up to 5 crores you are not liable for tax on it. Okay, one other change which is notable is the due dates. The due dates. Okay, audit due date has not changed. It is still 30th September, whereas furnishing of return is 31st October. Very welcomeable change. The report of the auditor shall be required under section 1 month before the due date. So, audit due date remains to be the same, whereas due date for filing of return is changed to 31st October. Is changed to 31st October. Hence, audit report should be furnished before 30th September. Not only in this section, wherever the word audit is appearing, this is the provision. Please read through. Only for students who have studied a old provision, I want them to understand the new provision. Okay, so first two questions are designed to make you understand the change with one very good interpretation, which we will see. Compute the eligible deduction under section 32. The question is not just depreciation. Eligible deduction under section 32 for the financial year 1920 and 2021, assessment year 2021 and 21-22 of a company located in the notified areas of the state of Andhra Pradesh. Indeed, the company is involved in manufacturing. Okay, and it is only plant and machinery, 15% block used in the manufacturing process. Opening WDV 53 lakh 80,000 additions. Okay, 180 days put to use for 180 days or more. Put to use for 180 days or more, 25 lakh 24,000. Put to use for less than 180 days. Okay, 21 lakh 10,000. There are no deletions, so let's not worry about it. Okay. Depreciation. Normal depreciation. Please understand. 53 lakh 80,000 plus 25 lakh 24,000 into 15% plus 21 lakh 10,000 into 7.5%. Repeating, opening balance plus asset used for more than 180 days will enjoy the whole of the amount So 53 lakh 80,000 plus 25 lakh 24,000 into 15% plus asset put to use for less than 180 days 21 lakh 10,000 into 7.5%. This is normal additional for financial year 1920. Additional for financial year 1920. Please understand 25 lakh 24,000 into 35% plus 25 lakh 10,000 into 17.5% because till financial year 1920, if the unit is located in the notified areas of the state of Andhra Pradesh, Telangana, Bihar, West Bengal, the rate of additional depreciation is not 20%, it is 35%. So half rate is 17.5%. Half rate is 17.5%. Okay. Closing WDV. Closing WDV. 74 lakh 17,500. 74 lakh 17,500. In this year, investment allowance under section 32 AD for FY 1920. Sir, I am not working this question for your learning, for your understanding, because I need you to understand what has gone. Okay, I need you to understand. So don't think that 1920 na padikanama, not necessary. If at all it is there in your mind, I want to remove it by making you understand what is the change it has gone through. So if you don't remember it, forget this question, be a normal, but one interpretation you have to understand. Okay, which is 15% of additions. So this will be 2524 plus 2110 into 15%. Okay. So total deduction under 32 will be, okay, depreciation normal plus additional plus investment allowance. In the last year, they would have claimed this as the total deduction. Okay, how does the current year work? Okay, that is our key factor. So this becomes my opening balance. My 19 lakh 15,000, 29 lakh 45,000. Okay, my normal depreciation comes to 74 lakh 17,500 plus 19 lakh 15,000 into 15%, 29 lakh 45,000 into 7.5%, no other change. Whereas my additional depreciation for financial year 2021 only 20%, ஓகே, ஆனா ஒரு இன்ட்ரெஸ்டிங் விஷயம் இருக்கு. ஓகே, so this into 20% plus this into 10% plus whatever is purchased in the last year, whatever is purchased in the last year and put to use for less than 180 days, that alone will continue to enjoy 17.5%. This is the only place where you can get 70. இல்லாட்டி நார்மலா அதுவும் 10% தான். But last year you have claimed only 17.5. This is the place where I want you to understand. If at all somebody want to test you, they can test you on this. Okay. Current year 20%. Current year put to use for less than 180 days 10%. But last year I have put to use for less than 180 days and claimed the 17.5% as the additional depreciation. The balance can be claimed. Balance now 17.5. The balance can be claimed in this current year. So it will become. So this will become 1915 into 20, 2945 into 10 plus. Okay. 10,46,750. This is the only possible change. I don't feel any other thing. It is rare that they are not going to ask you, but I'm just preparing you if at all some person asks. And the current year you can only claim 1620 plus 1046. Okay. This is the shift that happened between 1920 and 2021. Depreciation rate is no more, additional depreciation rate is no more 35% for those 4 special states, and only one place where I find a small place of question is, last year you have claimed 17.5%. The balance, law the balance can be claimed in the immediate succeeding year. So this rare than. And there is no investment allowance this year. Question number 2. In the above question, when assessee is not eligible to claim additional depreciation. Okay, ரொம்ப simple. Okay, question number 2. Additional depreciation cannot be claimed if the assessee opts for optional tax regime under 115 BAA, 115 BAB, 115 BAC, 115 BAD. In all these things, okay, if you are following, in the additional depreciation, நீங்க claim பண்ண முடியாது. If you can only claim normal depreciation. You can only claim normal depreciation. You cannot claim additional depreciation. Question number 3. Compute total eligible deduction. Again, I want you to understand how the law has changed. Adanala. Okay, right? right? Building purchased for scientific research. Last year also you can only claim 100%. Okay, 100% can be claimed. Current year also you can only claim 100%. Okay, that does not undergo any change. Machinery purchased by a manufacturing company. Machinery purchased by a manufacturing company for scientific research. Okay, machinery purchased by a manufacturing company for scientific research. Here only is the change. Last year they would have claimed 150% of cost of asset. But this year you can only claim 100% of cost of asset. Okay, here is the change. I just want you to understand how law has changed between 2 years. Okay, right? Yeah, YVJ, I think you have raised the hand. Yeah, you can ask me the doubt. Okay, I probably by mistake, or later you can send me. Okay, so 150% last year, 100% this year. Machinery purchased by a firm. அவங்களுக்கு போன வருஷமும் அது only அந்த கம்பெனிஸ்க்கு தான், manufacturing கம்பெனிஸ்க்கு தான் அந்த provision. Machinery purchased by a firm for a scientific research. Machinery purchased by a firm for scientific research. Okay, 100% of cost of asset. In the Varshamo, 100% of cost of asset. Okay, so for your understanding, I will write it here as here a change. Okay, this has changed, but nothing, those things are not changing. Okay, right. Contribution to SR to National Lab. Contribution for scientific research to National Lab. Okay, here it was 150% of amount contributed, but from now this year 100% of amount contributed. Okay, last year 150% of amount contributed, this year 100%. So there is a change. So there is a change in provision. Okay, contribution for statistical research. போன வருஷமும் 100% தான், இந்த வருஷமும் scientific research தான் change ஆயிருக்கு. Okay, contribution for statistical research. Okay, contribution for statistical research. Okay, in the words தான் ரொம்ப important. Last year also 100% of amount contributed. In the வருஷமும் 100% of amount contributed. No change. No change. In our statistical research, I did not give any excess deduction in the last year. Okay, sir, in the provision matra solli kudunga. I understand your mentality. I'm not confusing you. 100%. I'm not confusing you. I'm just helping some of our friends who would have studied the provision in last year. I just want them to understand what is the change. If you have only studied this year provision, please close your ears for a few minutes. I will complete this table. Okay. In the provision, I am particular, sir. Nothing wrong. We have time. Okay. Contribution of a company to a company whose primary object is promotion of scientific research. Okay. Contribution to the company whose primary object is promotion of research. Okay, last year it was 125% of amount contributed. This year it is 100% of amount contributed. So there is a change in the provision. There is a change in the provision. Okay, expenditure towards agree extension program. Expenditure towards agree extension program. Okay, 150% other than land. Okay, 100% other than land. Okay, there is a change. It has undergone a change. Okay, right. Purchase of land. Landனாலே எப்பயுமே டிடக்ஷன் கிடையாது. For developing a center of skill by a manufacturing company. Purchase of land for skill development. No deduction. Be it last year, no deduction. Landனாலே okay, landனாலே எந்த செக்ஷன்லயும், not only this section 35AD, okay, agri extension, scientific research, skill development, everywhere if it is land, no deduction. Okay, purchase of machinery for skill development. Purchase of machinery for skill development by a because this is manufacturing companies only. Okay, last year it was 150% of expenditure. This year it is only 100% of such expenditure. Okay, so there is a change in the provision. There is a change in the provision. Okay, last, audit report under 33AB. Remember, there is no change. Return date தான் மாறி இருக்கு. Okay, 30th September, last year also, this year also 30th September. Extension பத்தி I am not talking. I am just telling, okay, as a provision, it has not undergone change. Okay, these are all the provision which has undergone change, which will be useful when you are studying. It will be really useful when you are studying, especially those who have studied under the old provision. For those friends, I want to help. That's why I framed the first two questions. That's why I framed the first two questions. Okay, right? From question number 4, we will continue in the evening. From question number 4, we will continue in the evening. In the evening, we will be able to complete all the business or profession capital gains, IFOS, very small things, and proceed towards some of the income things. Okay, by evening we will again start and go with question number from question, because question number 4 is going to be little elaborate, where the last time I'm going to work in this amendment class about the optional tax regime. By that time you will get the grip of optional tax regime. So just keep munching. We will meet in the evening exactly at 6 o'clock, same link, where we will discuss more about amendments. Meet you in the evening. Thank you, my dear friends. All the very best. Namaste. Good evening. The session to focus upon a lot of amendments applicable for 2021 examination, whenever the examination is held, and this is applicable for the whole of the year whenever the examinations are going to be held. Okay, this morning we had stopped with question number 3 of the PGBP amendment. When we speak about the PGBP amendment, we were only looking at 44AB as one of the main amendment, and there is an amendment in 43CA which we will cover along with section 50C, but the major amendment happened in 44AB. Other than that, almost all the amendments, we when it is incorporated into the law itself, we know that those things are going to end by 1920, or subsequent amendments to law said that they will end by 1920. That's why majority of the things we saw. Okay, our friend, our classroom friend, also reminded me of one more thing. Okay, which is nothing to do as such as an amendment, but the depreciation pertaining to motor car. The depreciation pertaining to motor car. Okay, what is the significance of that amendment? In one of the years, we had the depreciation rates of motor car as, instead of 15 and 30, 15 for general car, buses, lorries, which are used in the business of running them on hire. Okay, more for they being the main source of income, it was 30%. In one of the year, this was changed. In one of the year, this was changed to 45%. In one of the year, this was changed to 45% for motor car running them on hire, and 30%. That is for a particular period. In this year, if you purchase, it's back to the old rate of 1530. That is, in the financial year 1920, if they had purchased, there was a different rate. In the financial year 2021, which is what is our examination year, there is no change. So, this amendment, okay, Finance Act, it was not even an act, it was a subsequent, okay, Amendment Act, okay, for financial year 1920, for financial year 1920, okay, applicable for motor vehicles purchased from 23rd August, okay, 23rd August 2019 to 31st March 2020, okay, 31st March 2020, okay, rate of depreciation, okay, motor car, bus, lorries used in the business of running them on hire was, okay, increased to 45%, was increased to 45% instead of 30%. Okay, other, okay, other motor car, it was increased to 30%. It was increased to 30%, and this continues. That is, if you have purchased during this period, even in 2021, you can claim the 30% or 45%. Okay, in that year, we had a dip on the car segment, a mechanical engineering or mechanical product segment. There was a very big dip. Economy was not doing well in that segment. So the finance minister gave an additional or accelerated depreciation for all vehicles purchased between 23rd August 2019 to 31st March 2020. And if the vehicle is purchased during that period, even for the current year, that is 2021, even now 21-22, the rates will be 30 and 45%. Okay, 30 and 45%. But if it is purchased during the year 2021 or now 21-22, the rates are back to 15 and 30% respectively. Okay, I don't see a question over there. I don't, okay, but when I am doing I will remember this when we are touching upon revision classes. we will work out the question, okay, and we will work out parallelly where it will have an impact. Okay, I will definitely work out. Okay, yeah, thanks to Lalita for reminding me that this morning. Okay, now I am going into question number 4. The question is framed with lot of things in my mind. Okay, so that you are getting a 365-degree look at individuals. Okay, question number 4. Mr. Bharatwaj commenced the business of storage of agricultural products, which qualifies under 35 AD in the financial year 2021. Net profit before claiming deduction under 35 AD 1 crore 5 lakh. Cost of construction of warehouse which is eligible for depreciation of 10% 1 crore 89 lakh. Cost of land included in the above cost. Okay, so which we all know land is not allowed as a deduction 65 lakhs. Other income, interest income, dividend from domestic company, interest paid for earning such dividend income, investment eligible under section 80C, medical insurance premium eligible under 80D. Compute the total tax payable after considering all options and suggest which has to be chosen. Which has to be chosen. Okay. I told you that section 35 AD has become now optional. It is not mandatory for the assessee to claim 35 AD. It is now optional. Okay, I'm going to give you a holistic perspective by working out this question. Lot of things can be clear from our, we'll remember a lot of things. We'll get reminded of a lot of things. Where assessee opts for 35 AD, where assessee is opting for 35 AD. Okay, this is part 1. Okay, in this computation of total income. Computation of total income. Business or profession. Business or profession. Okay. Profit before claiming, okay, section 35 AD. Profit before claiming section 35 AD 1 crore 5 lakhs. Expenditure under section 35 AD other than cost of land. Expenditure under section 35 AD other than cost of land. Expenditure under section 35 AD which is 1 crore 89 lakhs minus cost of land is 65 lakhs. Okay, 1 crore 89 lakhs minus 65 lakhs. Okay, loss from specified business. Loss from specified business. Okay, we all know this loss cannot be set off against any other income. We are all aware that this loss which arises due to specified business cannot be set off. Okay, This cannot be set off against other income. This needs to be carried forward and set off only against income from specified business. This needs to be carried forward and set off only against income from specified period. Okay, business maximum. Okay, indefinite. Okay, set off. Okay, there is no maximum period. We all know indefinite. So this is the important thing to understand, that this loss cannot be set off. Fine. Other sources. Okay. Interest income 17 lakhs. Interest income. Dividend income. Okay. Dividend income 9 lakhs less section 57 allowance. Okay. Actual interest. Actual interest is 2 lakhs. Okay. 20% of dividend income. 20% of dividend income. Okay. 1,80,000. 1,80,000. So whichever is less, okay, whichever is less, so 1,80,000. So I can, my taxable dividend income comes to 9 lakhs minus 1,80,000, 7,20,000. 7,20,000. My gross total income, my gross total income is 17 lakhs minus 7,20,000, 980. Deduction under chapter 6a. Deduction under chapter 6a. Okay. 80. Listening? 80C, my dear friends. Okay. 80C is 1,50,000. 80C is 1,50,000 and 80D, okay, restricted to, okay, it is maximum 25,000. Okay. Okay. So my total income comes to 8,05,000. My total income comes to 8,05,000. I have a carry forward item, okay, in specified business of 19 lakhs. My total income comes to 8,05,000. Computation of tax. Base tax, okay, 8,05,000 minus 5 lakhs into 20% plus 12,500. 8 lakh 5, 3 lakh 5,000 into 20%, 3 lakh 5,000 into 20% plus 12,500. Add HEC at the rate of 4%. Add HEC at the rate of 4%. Total tax payable. Total tax payable is, okay, 76,440 and not yet over. 76,440. Okay. 76,440. Okay. Okay. Up to this, please come.
So can you scroll up?
Yeah, sure.
The gross total income 9 lakh PPD missing.
Thanks, 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 thanks. I think I detected. Yeah, it is 17 plus 7, 24, 20. Thanks for correcting me. Yeah, thank you, Raja. Shall I progress? Shall I progress? Now, whenever we do like this, we continue saying computation of adjusted total income. When three things should be there in our mind to prepare this. In the case of individual firm or anybody, okay, if we have claimed a 35 AD, 10 AA, and 80 Is. Shall I repeat? If we have claimed expenditure under 35 AD, exemption under 10 AA, deduction especially in 80 Is, we should remember to work out alternative minimum tax also. We should remember to work out alternative minimum tax also. Total income after considering all exemptions, expenditure, and deductions. Okay, and deductions. Total income after considering all these things comes to 22 lakh 45,000. Okay, and expenditure under section 35 AD, and expenditure which we have claimed under section 35 AD 1 lakh 1 crore 24 lakhs less less, okay, depreciation at the rate of 10% on asset claimed as deduction under 35 AD. Depreciation at the rate of 10% on the asset which I have claimed as deduction under section 35 AD. This, okay, into 10%. Okay, 12 lakh 40,000. 12 lakh 40,000. So adjusted total income. Adjusted total income. Okay, 1 crore 34 lakhs 5,000. 1 crore 34 lakh 5,000 adjusted total income. Okay, computation of alternative minimum tax. Computation of AMT, alternative minimum tax. Computation of AMT. AMT at the rate of 18.5%. AMT at the rate of 18.5%. Okay. Alternative minimum tax at the rate of 18.5%. And surcharge at the rate of 15%. Income has exceeded 1 crore. Income has exceeded 1 crore, even though it consists of dividend income. Only if it has gone to 25 or 37%, I need to rework. Here, no problem. Directly 15% surcharge. Okay, if the income exceeds for an individual 50 lakhs, 10%, exceeds 1 crore, 15%, exceeds 2 crore normal income, 25%, exceeds 5 crore, 37%. Add HEC at the rate of 4%. Okay, add HEC at the rate of 4%. Okay, into 4%. So my total tax payable under AMT, okay, comes to, my total tax payable under AMT comes to 29 lakhs 65,990. Okay, assessee is liable to pay either tax at normal rates or AMT, whichever is higher. So he will be paying 29 lakh 65 990. Tax credit to be carried forward. Tax credit to be carried forward, okay, is 2965,990 minus the normal tax payable, okay, right? Tax credit to be carried forward 2460,550. 2460,550. He will be liable to pay 2965,990, and the tax credit he needs to carry forward is 24 lakh 60,550. He'll be eligible to carry forward, which he can set off in the year in which he pays normal tax. He can set it off in the year in which he pays normal tax. Where assessee do not opt for 35 AD, where assessee do not opt for 35 AD, which means he is, okay, following alternative tax regime, or you can call it as optional tax regime, where because section 35 is now made optional, it is not mandatory that one should claim section 35 AD. A person can say that I am not going to claim. In that case, this working, how it is going to change? Computation of total income. Business or profession profit before claiming depreciation, okay, for asset purchased for specified business. Okay, that profit comes to 1 crore 5 lakhs less depreciation at the rate of 10% on building. Because you are not claiming 35 AD, you can claim depreciation. You can still claim depreciation for that. So we already have that ready. Okay, we already have that ready. Okay, when we worked out alternative minimum tax, we did that. Okay, 12 lakh 40,000. 12 lakh 40,000. So our 92 lakh 60,000. Other sources as computed. We already have it ready. We computed and kept it ready. Okay, other sources. Okay, okay. It is 17 lakhs plus 7 lakh 20,000. It is 17 lakhs plus 7 lakh 20,000. Okay, for your understanding, 17 lakhs plus 7 lakh 20,000. Okay, this is our other sources. Okay, total income, because you cannot claim 80C or 80D, any deduction cannot be claimed. Any deduction except two things: 80CCD subsection 2 and okay, and 80JJAA. Other than that, you cannot claim. So total income comes to okay 1 crore 16 lakh 80,000. Okay, computation of tax, base tax will be okay, my dear friends, 1 crore 16 lakh 80,000 minus 15 lakhs into 30% plus 187,500. Okay, 1 crore 16, because we are under alternative or optional tax regime. That's why I am not claiming 35 AD. Okay, so 32 lakh 41,500. 1 crore 1680 lakh. First 15 lakhs we all know 1 lakh 87,500. Remaining 1 crore 1 lakh 80,000 into 30%. 1 crore 1 lakh 80,000 into 30%. Okay, hope this is right. Okay, right. And surcharge at the rate of 15%. Add surcharge at the rate of 15%. Surcharge, okay, all special rates are all remaining constant. Okay, law there will be a term, all other provisions will be applicable. All in the exemption law, these are not allowed. All other provisions will be applicable. There is a perennial dispute once, whether 234B and 234C will apply for 115 JB book profit. Then NJ Joe's case, they said yes, it is applicable. Even before that, they have said it is applicable. Why? Because all other provisions of the law are applicable. So those will also be applicable. HEC at 4%. So he will be paying more tax, and there is no tax credit also. He will be paying more tax and there will not be any tax credit. So assessee should not go for the alternative of not choosing 35 AD. He should choose 35 AD for the two reasons. One, the tax is also low for the current year. Second, there is a bulk of the amount which can be carried forward. On an optional tax regime prefer pantena, even the AMT credit brought forward cannot be claimed. Cannot be claimed. Patiently work through, look through. Okay, friends. Okay. So,
Sir,
yes, sir. I'm listening, sir.
sir, could you just explain that base tax 15 lakhs computation alone?
Sir, we are in alternative tax regime, sir. In alternative tax regime, the rates are up to 250 mil, 250 to 5 lakh, 5%, 5 to 750, 10%, 750 to 10 lakhs, 15%, 10 to 12.5, 20%, 12.5 to 15, 25%. More than 15 lakhs only, it is 30%. More than 15 lakhs only, 30%. So this morning, we understood that up to 15 lakhs, okay, up to 15 lakhs, our tax is approximately 187,500. Okay, up to 15 lakhs, our tax is 1,87,500. More than that, it comes to 30%. So in this question, we have adopted that is 1 crore 16 lakh 80,000 minus 15 lakhs, because up to 15 lakhs it is 187,500 minus 15 lakhs into 30% plus 187,500. That's what is base tax.
Thank you, sir.
Sir,
Listening.
ஒரு ஆப்ஷனல் டாக்ஸ் ரெஜிம்ல டாக்ஸ் கம்மியா இருந்ததுன்னா என்ன அட்வைஸ் பண்றது சார்? ஏஎம்பி கிரெடிட்
Optional
வர
tax regime la kammiya irundhuduna kuda, for example, if this question, even if it is less, it is only for the current year, but we will use that AMT carry forward benefit. I would why I will tell you one more reason. Suppose you are a business or profession assessee, you don't have the option of tangling between the years. Once opted for, you have to stay. So even if it is less for the current year, don't write a blank conclusion that it is. However, considering the tax credit, the assessee should still go in for main only.
Sir, is AMT credit same period of 15 years, sir, carried
Yes, sir,
forward?
yes, sir, yes, sir. Yes, sir. Yes, sir. Okay, so this question is a comprehensive look at all the three taxation, that is normal tax, okay, AMT and optional tax regime, okay, with an assurity that this will never happen. If I am the examiner, I would give a question like that, that will never happen. Okay, so do not worry. Okay, right. Now you can say, feel that, okay, he should have been, because you know that. Question number 5. This is for the 44AB amendment. This is for the 44AB amendment. The total receipts and payments of an individual carrying on business is provided. Specify whether such individual is bound to get his books audited. Sale of goods 250 lakhs, of which 10 lakhs is by way of cash. Sale of asset 4 lakhs by cash, totally 80 lakhs. Scrap sales fully received in cash 5 lakhs. Interest income, miscellaneous receipts. Okay, wherever it is not given in bracket, it means it is bank only. If it is cash, it is given in bracket. So this leads me to go back to the theory once and study it. This leads me to go back to the theory and to understand it once more. Okay, aggregate of all amounts received for sales turnover, including that, should not, and the cash portion should not exceed 5%. Aggregate of all payments. Okay, so it is not only for sales, it is aggregate of all amounts received. Receipts and payments money. Okay, receipts, we are all very clear in our 11th standard, 12th standard, we enjoyed something known as double columnar cash book. Cash column, bank column on both sides. The debit side is known as the receipt side. So, if we total it, cash column, bank column, if I total it and give a total to that, and if the cash column exceeds 5% of that total aggregate of cash and bank, then okay, so so there is a whatever we studied in our very early stages of our life, always that is only useful. Okay, so that concept comes here and helps us. Okay, right, friends. Question number 5. Okay, normally what happens is, if the gross turnover, exclusively this time sales, exceeds 1 crore, tax audit is applicable. 44AB audit. Audit is mandatory under 44AB. Okay. In the examination also, a similar question is going to come. Okay. If it is not an objective type question, if it is an explanatory, start from there, the theory. Okay. Start from there, the theory. In case of business, if the gross turnover exceeds rupees 1 crore, then audit is mandatory under 44AB, provided assessee has not opted for 44AD. Okay, that presumptive taxation. Okay, I know this அப்படின்றதுக்காக you can write it, or not a problem. Okay, so if the gross turnover, okay, however, FA 2020, Finance Act 2020, okay, has given a relief for assessees whose turnover or whose gross receipts does not exceed rupees 5 crores, whose turnover, whose gross receipt does not exceed 5 crores. Okay, the condition is that cash receipt or cash payment should not exceed 5% of total receipts or total payments, as the case may be. If the okay, the condition is that cash receipt, okay, if it exceeds, go back to 1 crore. If it does not exceed, there is a possibility of 5 crores. There is a possibility of 5 crores. First, we will analyze receipts. Okay, gross receipts, particulars, cash, other modes. Okay, other modes is a better word because in the credit card ellame other modes. Instead of writing bank, you can write bank, but other modes is a better terminology. Sale of goods, so cash portion is 10 lakhs, Okay, other modes 250 lakhs. If the connection becomes little unstable, I will definitely switch over. So do not worry if there is a connectivity issue. Minus 10 lakhs. Okay, 2 crore 40 lakhs. Sale of assets, of which 4 lakhs. Okay, so 80 minus 4 lakhs. Okay, sale of scrap, it's fully being in cash, 5 lakhs. Okay, interest income, all receipts has to be taken if it is credited into our P&L. Okay, 48 lakh. Receipts miscellaneous receipts 42 lakhs. Okay, right, in this case, okay, cash receipt as a percentage of total receipt. Cash receipt as a percentage of total receipt, 19 lakhs divided by 4 crore 25. Okay, as a percentage, if I see, it is only, sorry, it is only 4%. It is only 4%. No problem. It is only 4%. So, in terms of receipt, we are satisfied. Even though my gross turnover is more than 1 crore, even though my, in fact, more than 2 crores, and 2 crores in the kuda, I can still opt for 44 AD, but here it is already 2 crore 40 lakhs, so that 44 AD option is also gone. That 44 AD option is also gone, but still there is a possibility I need not worry about my tax audit, because as of now, cash reserve. Now we will compare cash, the gross payments. Again, only 4%. Again, only, okay, if you get in calculator 4.02, 4.03, okay, write that amount, whatever you are getting. Okay, I am rounding it off, but whatever you are getting as it is, right. Again, okay, since the cash receipt or cash payment does not exceed 5% of total receipt, or total payment, okay, respectively, and the gross turnover has not exceeded rupees 5 crores, okay, assessee is not liable to get his books audited under 44AB. Assessee is not liable to get his books audited under 44AB. Okay. So these are all the amendments and related questions. Okay. Amendment is 44AB. 35 AD made optional, we worked out a question, and also the past things that have changed, including the car. I remember that to work out in the revision session. But as such, if you ask me what is the questionable area, 44AB is a questionable area. They might definitely try to either as objective or as descriptive, they can be a question. Okay, right. Otherwise, optional 35 AD is really rare, but not ruling it out. Okay, probably companies related hour, but still. Okay, and moving into the next arena, capital gains. The next arena, okay, so salaries la ESOP and total contribution by employer to employee welfare funds, either into amendment. Okay, PGBP, no amendment in house property. Now moving into capital gains. Okay, I will go to two simple amendments and come to segregated portfolios or side pocketing. Okay, too simple in the sense, not simple in terms of anything else, but easy to understand. Cost of acquisition of asset purchased before 1/4/2001. Cost of acquisition of asset purchased before 1/4/2001. What we were so far studying till the financial year 1920, for all assets purchased before 1/4/2001, either actual cost or fair market value as on 1/4/2001, whichever is higher, whichever is beneficial. எதனால? Because the base year for indexation is 2001-2. The base year for indexation is 2001-2, and that is why we have been saying fair market value as on 1/4/2001. That has not changed. But there is an addition exclusively for immovable property. Okay, for all movable property, the rule remains the same. Actual cost or fair market value as on 1/4/2001, whichever is less. For an immovable property, there is a addition. Okay, in case of immovable property, the addition is only for immovable property, my dear friends. The addition is only for immovable property. The fair market value should not exceed the stamp value on 1/4/2001. Where it exceeds, stamp value will only prevail. Okay? இன்னொரு விதமா சொன்னா, If I have purchased it for, let us take 10 lakhs before 1/4/2001. The fair market value as on 1/4/2001 is 20 lakhs, whereas stamp value on that date is only 18 lakhs. Stamp value as on 1/4/2001 is only 18 lakhs. My fair market value should be disregarded. I can take only fair market value. I can take only fair market value. So, post this amendment, what we can understand is cost of acquisition only for immovable property shall be actual cost, or amongst these two, whichever is less, amongst them, whichever is higher. Actual cost. First, okay, FMV as on 1st April 2001 or stamp value as on 1st April 2001, whichever is less, அதுதான் it will stand. Okay, then compare it with actual cost, whichever is higher. Whichever is higher. The next amendment which gets importance, which really gets importance because it is going to cover three different sections. It is going to cover three different sections. The sections are 43CA, where immovable property is held as stock in trade. 43CA, immovable property held as stock in trade. 50C, immovable property held as capital asset. Immovable property held as capital asset. 56(2), gift of immovable property received. Gift of immovable property received. Once more I am repeating. 43CA, immovable property held as stock in trade. 50C, immovable property held as capital asset. 56(2), I received immovable property as a gift or inadequate consideration. Tolerance limit is increased to 10% instead of the existing 5%. That is actual cost or stamp value, whichever is higher. However, if the stamp value does not exceed 110% of the actual cost, 110% of the actual cost, instead of 105%, 110, still actual cost, okay, variation, okay. Now, colloquially, we used to say here and there 10%, okay, plus or minus 10%, that is it. Okay, this is a colloquial terminology becoming a legal terminology. Okay, accordingly, full value of consideration on sale of immovable property held as stock in trade 43CA, capital asset 50C, shall be actual consideration or stamp value, whichever is higher. However, where the stamp value does not exceed 110% of the actual consideration, then actual consideration will only prevail. So the tolerance limit is 10%. Similarly, for the buyer, if the inadequate consideration, what is inadequate consideration? Difference between stamp value and consideration paid exceeds 50,000, such inadequate consideration will be treated as income. We all know it will be treated as income. However, where the stamp value does not exceed 110% of consideration paid, even though it exceeds 50,000, it will not be taxable. Please read through. Okay, okay, right, okay. Uh, I will not deviate. I know it's the amendment session and time everything. I will not deviate much. But UTI had this peculiar problem that they had some of their investments, mutual fund, okay, some of their investments were not doing great, but their other investments are doing great, okay. So they did something very popular, side pocketing. Whichever investment they are not doing well because of the CRISIL rating or because of various other factors, others separate பண்ணாங்க. Okay, these which are doing extremely well, these which are not doing it well, so that redemption on this will be better. For this, there will not be a redemption or people have to wait for it to do well. And the money they brought some schemes, etc. And government immediately, SEBI allowed this in the year 2019. SEBI allowed this. Okay, they allowed this segregated portfolio. Your total portfolio is divided into two: portfolios which are doing very well, portfolios that are affected due to credibility. Portfolio is nothing but where you are investing. You means mutual fund. Where the mutual fund is investing, that is known as a portfolio. That is split into two: portfolios which are doing well, portfolios which are affected due to their credibility. Okay, so I am taking them out of the total portfolio. So I call it as segregated portfolio for a technical reason. For a colloquial reason, I call it as side pocketing. Side, adala, I am setting it aside and playing with my main portfolio. In the Finance Act 2020, income tax law recognized such segregation, and they said how it can be taxable. Concept of segregated portfolio and its taxation. Okay, SEBI introduced the concept for mutual fund, which can bifurcate their holding into main portfolio. What is main portfolio? Those investments which are performing well, and the other is known as side pocketing or segregated portfolio, which means those units which are downgraded, whose credibility is affected in the debt or money market. So the portfolios are divided into two: main portfolio, side pocketing or segregated portfolio. Okay, so நமக்கு இவ்வளோ terminology வேணாம்னா you understand it in the banking terminology of performing asset, non-performing asset. For a quick understanding, we are aware that bank classify their loans into performing, non-performing. NPA is one which is not giving the bank the real benefit. Okay, performing asset, the interest you will recognize fully. Non-performing asset, the interest you might not recognize it fully. Okay, back on it na பார்த்ததில்ல, but from my memory. Extrapolate the same concept to a mutual fund. A performing asset is known as the main portfolio, and a non-performing asset is known as a segregated portfolio. Main portfolio, segregate. So total portfolio, in that you are segregating some portfolio. Main portfolio is equal to total portfolio minus segregated portfolio. Mutual fund or investors judge mutual fund based on net asset value. We all judge it by name of net asset value. Otherwise questionable. These segregated portfolio reduces the net asset value because their credibility are respecting. by the side pocketing methodology, NAV, that is the net asset value, will be separately identified for, sorry, it's main and segregated portfolio. By the side pocketing terminology methodology, NAV will be separately for main portfolio, separately for segregated portfolio. Okay, right? Why this characteristic? Main portfolio can be redeemed by the investors at any point of time. Main portfolio can be redeemed, whereas segregated portfolio, which are allotted in the same ratio, holds to total ratio, are not redeemable. Segregated portfolios, okay, you need to wait to redeem it, are not redeemable. Okay, and they will have a different NAV. In the year of redemption, it is taxable. How to? Here I am only coming to tax point. Taxation of segregated portfolio. Holding period will be from the main portfolio, the date of its acquisition. Date of splitting illa. Okay, holding period will be whenever I acquired it, it would have been main portfolio at that time. Okay, or it would have been in the total portfolio whenever I acquired it. Adutha, not the date of splitting. Acquisition date will only be considered. Cost of acquisition shall be on proportionate basis. Cost of acquisition shall be on proportionate basis. Please read through once. Theoretical question it can be. I will take it as a general doubt and answer. Please read this. I will take Lalita. I will take this as a general doubt. I understand what you're asking.
Sir,
Listening, Raja.
sir, this proportionate basis, on what proportion do we split?
That is, cost of segregated portfolio is equal to NAV of the total portfolio and divide it in the ratio of NAV of main portfolio and segregated. I will do a question and show you. I'll do
Thank
a
you, sir.
question and show you. Before progressing, in the question Lalita has asked me a doubt that if I am claiming 35 AD, can I claim deduction under chapter 6A? Yes, Lalita, you can claim. Probably check it out. We cannot claim deduction under section 80. That is, for the same business, you cannot claim. Okay, for the same business you cannot claim both 35 AD and 80 IA. Okay, I have always told you three sections: 10 AA, 80 Is and 35 AD. All speaks about almost the same businesses. So if you are claiming one, the other two gates closed. So it would have been written as, if you are claiming exemption, deduction or expenditure under 35 AD, assessee is not eligible to claim 80I. Assessee is not eligible to claim for the same business. But here it is 80C and 80D, and this will be more from the dividend and interest income, which becomes taxable. So this can be claimed.
Okay, sir.
Chanakya invested 8 lakhs in the mutual fund scheme on 1st April 2017. In Jan 2021, the NAV of the scheme is 40 lakhs. The fund decided to segregate the portfolio which were affecting its creditworthiness. Hence, 10 lakhs worth of portfolio are side pocketed and the balance 30 lakhs became the main portfolio. From the perspective of Chanakya, what are all the impact specified? Read through. NAV of total portfolio. NAV of total portfolio 40 lakhs. Segregated or side pocketed portfolio 10 lakhs. Main portfolio is equal to total portfolio minus segregated portfolio for the investor, that is Chanakya. Cost of acquisition of segregated portfolio. Okay, cost of acquisition of segregated portfolio is equal to actual cost into NAV of segregated portfolio divided by NAV of total portfolio. Okay, cost of segregated portfolio is nothing but he purchased it for 8 lakhs. He purchased it for 8 lakhs into 10 by 40. Okay, into 10 by 40. Okay, so 8 lakhs into 10 by 40. Okay, 2 lakhs. Okay, this will be the cost of segregated portfolio. At the time when the segregated portfolio performs well and is redeemed, okay, this can be claimed from the redemption value. Okay, so cost of segregated portfolio 2 lakhs. இதை எப்போ claim பண்ணலாம் இந்த COA? Only when the segregated portfolios are redeemed. At the time when the segregated portfolios are redeemed, that is they are performing well, they will be part of main portfolio. Okay. However, for computing the classification, that is either short term or long term, for computing the classification, date of original purchase and not date of segregation is only relevant. Okay, for knowing whether it is a short-term capital asset or long-term capital asset. Date of original purchase. In our case, it is 2017. 1/4/2017 is only relevant. Okay, date of original purchase is only relevant and not date of segregation. So in our case, it will be 1/4/2017. Okay. Okay, this is only relevant. Okay,
Sir?
see,
Hello?
listening.
Hello, sir?
Yeah,
Okay.
listening.
So this 10 is to 30 will keep on changing also, the
10 is
ratio.
to 40. Segregation date is fixed.
Oh, as on the date of
Yeah,
segregation.
as on the date of segregation.
Okay.
Cost of acquisition of main portfolio. Okay, cost of acquisition of main portfolio. We all know 8. Okay, it is okay, 8 lakhs minus whatever is segregated, 6 lakhs. Okay, 6 lakhs. Whenever main portfolio are redeemed, okay, this can be claimed as COA and the balance taxable either as STCG or as LTCG.
Sir,
Listening?
sir, this provision is only came because investors will be able to sell the credible and non-credible separately, right, sir?
Yes,
Or any other?
yes, yes. Investor cannot sell the or redeem the non-performing portfolios. That's why this provision. Tax friendly then, because you can, instead of claiming 8 lakhs, they are only claiming COA of 6 lakhs. Okay. Uh, I don't think practical question is going to be there. There can be a theoretical question or simple case law question like this, where you need to just mention the numbers and not the computation. Okay. If at all I find practical question, I'll work down. Question number 2. Danya inherited her grandfather's property in July 2005. Okay. In July 2005. Her grandfather has acquired it in 1980s for 6 lakhs. The fair market value as on 1/4/2001 51 lakhs, whereas the stamp value was only 49 lakhs. Danya sold the property during the year for 3 crores, incurred stamp duty of 12% on sale consideration. Danya invested in 2 properties, each costing 80 lakhs. Compute the CG taxable in the hands of Danya. Read through. First, let me theoretically write down. Okay. Property acquired before 1/4/2001. Actual cost, okay, actual cost of acquisition, okay, by her grandfather, okay, 6 lakhs. FMV as on 1/4/2001, FMV as on 1/4/2001, 51 lakhs. Stamp value as on 1/4/2001, okay, 49 lakhs, 49 lakhs, okay. According to the amended law, okay, stamp value, okay, FMV cannot exceed stamp value on such date. Where it exceeds, then stamp value will only be considered. Okay, according to the amended law, FMV should not exceed. If it exceeds, I am going to only consider stamp value. So 6 lakhs or 49 lakhs, whichever is more beneficial, I will only take 49 lakhs as my FMV, as my cost of acquisition, Remember, whenever the actual cost or the fair market value, whichever is higher, the normal law, amended law says for immovable property alone, the amended law is applicable. Obviously, for that only stamp value, okay, stamp value on that date, on 1/4/2001, should be identified. FMV should not exceed the stamp value. If FMV is lesser, I will take FMV. Whereas if FMV is more than stamp value, then stamp value will only prevail, not FMV. Not FMV. Okay, based upon that only we are going to work out this particular question. And interestingly, as in our classroom, we are going to work out this question like as per law, as per Manjula J. Shah, okay, judgment. Okay, right? As in our classroom, we will work out in two methods because it is an inheritance question. It is an inheritance question. Gift, inheritance, or in other words, wherever we are going to take the cost of the previous owner, it is better to work it out so. Okay, full value of consideration, okay, she has sold this property for 3 crores. Okay, right, less cost of acquisition, cost of transfer. Okay, she has paid 12% stamp duty. She has paid, okay, she incurred stamp duty 12% of sale consideration. So she has paid stamp duty 12%. Okay, net consideration. Okay, less ICOA. Okay, as per law, it will work out like 49 lakhs into 49 lakhs into, for our year, we all know it is 301. For our year, we all know it is 301. Okay, 301 by 100. Okay, so 49 lakhs into 301 by 100. Following the Manjula J. Shah judgment, it will be 49 lakhs. Following the Manjula J. Shah judgment only, this is. Okay, this is as per Manjula J. Shah judgment. But following the law, it will be 49 lakhs into 301 divided by, it has been acquired in July 2005. July 2005 happens to be financial year 56. Financial year 56, 117. Okay, it will be 117. Okay, if you go as per law, divided by the year in which asset was first withheld by the assessee. Assessee hold it only from July 2005. July 2005 falls in the year 56. Okay, so this is 2005-6. Assessee holding it for the first time. Gross LTCG. Gross LTCG. Okay, gross LTCG. Okay, this is the point I want you to understand more importantly. Okay, gross LTCG, that is 49 lakhs the cost of acquisition, not 51 lakhs. And we know the two judgments, just to recollect that. Okay, Danya invested in two properties. Okay, section 54. Since the gross LTCG, since the gross LTCG has not exceeded rupees 2 crores, since the gross LTCG has not exceeded rupees 2 crores, assessee is eligible to claim deduction for two properties. Okay, in both the cases, it has not exceeded 2 crores. So, fine, assessee is eligible to claim deduction for both the properties. Assessee is eligible to claim the deduction for both the properties. So, obviously, capital gain will be nil. Okay, but one other value added answer, if you remember in the examination. Okay, however, the benefit of claiming two properties will be only once. Okay, again you cannot claim for two properties. You can continue to claim for one, but this two properties is only one if you remember in the examination. Okay, 2 or 3 years down the lane, the question can be already as claimed. Okay, at that time you will be a chartered accountant. By reading that question, you will remember me and smile. That is enough for me. But generally, okay, these two properties can be claimed only once. Question number 3. Harihara Prasad, a property dealer, sold immovable property to Ashwin on 16th December 2020. Ashwin paid a total value of 75. As Harihara Prasad, a property dealer. For him, the provisions of 43 CA is applicable. Ashwin paid a total value of 75 lakh for the said properties. The stamp value on the date of agreement 80 lakhs and date of registration 85 lakhs. Ashwin has paid 10% as sale consideration advance, okay, sale consideration through banking channels. Harihara Prasad has purchased this property in 2019, 1st January 2019 for 60 lakhs. He has incurred cost of improvement 7 lakhs. So from the top, Harihara Prasad, a property dealer, so 43 CA is applicable, property dealer, sold immovable property to Ashwin on 16th December. Ashwin paid a total consideration as 75 lakh, the stamp value on the date of agreement 80 lakhs and the date of registration 85 lakhs. Ashwin has paid an advance of 10% through banking channel. Harihara Prasad has purchased this property in Jan 2019 for 60 lakhs, incurred improvement cost of rupees 7 lakhs. Compute the impact of the transaction both in the hands of the buyer as well as seller. 2. How will your answer change if Harihara Prasad is not a property dealer and the immovable property is held by him as a capital asset with all other information being the same? 3. What will be the impact if Ashwin has not paid any advance and the full sum is paid on the date of registration. One question for a global understanding of this entire 50C and 43CA. Okay, one question for a global understanding. Take a quick look at the question. We'll go to the answer.
Sir?
Yeah, listening.
Sir, in the previous question, that Manjula Desha was applicable only in case of gift, will, or inheritance, right, sir? Only 3 modes, or any other is possible, sir?
For an individual, only these are possible. For any company, amalgamation, holding company, subsidiary company transfer, these are possible.
Okay.
Firm converted into a company.
Oh, okay, sir. Okay.
Computation of business profit of Hariharan. Computation of business profit of Hariharan. Let me give you a small perspective. Okay, a quick perspective of 43CA, okay, which is also for 50C later, okay, which is also for 50C, sorry, and which is also for 56 too, okay, right? 56.2 is from the receiver's perspective. Okay, so slightly the wordings might change. So let us only restrict ourselves to 40CA and 50C. Okay, right? Consideration will be actual or stamp value, whichever is higher. Okay, however, if stamp value, okay, does not exceed 110% of actual consideration, then actual consideration will be taken. Okay, if stamp value does not exceed 110% of the actual consideration, then actual consideration will only prevail, not stamp value. Okay, on the question of on what date I should take, on the question of stamp value on what date, okay, where advance is received by approved modes, prescribed modes, which I have given you the list in PGBP itself. Okay, cross the account pay check, not cross check, account pay check, account pay draft, and the list of items. Account pay check, account pay draft, and the list of items. Where advance is received by approved modes, then stamp value on the date of agreement. Okay, where advance is not received or received by cash slash bearer check slash cross the check. Cross the check is not acceptable thing. Okay, where advance, account pay check and cross the check are different. Where advance is received or not received or received by cash, bearer check, okay, or cross check, okay, stamp value on the date of registration. Stamp value on the date of registration. Okay, only this is new. These two things you just recollect. Okay, that's all. So I will work part 1 and part C together. Part 1 and part C together. Okay, I will work part 1 and part C together. Okay. Part 1 and part C together. Uh, No, தனித்தனியாக work பண்றேன். The question is framed in such a manner, so let me work out separately. Okay, part A, sale consideration. Okay, sale consideration, how to work out? Okay, actual consideration, actual sale consideration, okay, for a total value of 75 lakhs, for a total consideration of 75 lakh. Stamp value on the date of agreement, since advance is paid through approved modes. Okay, stamp value on the date of agreement 80 lakhs. Okay, 80 lakhs. Okay, 110% of actual consideration, 110% of actual consideration. Okay, since the stamp value has not exceeded 110% of actual consideration, actual consideration will be taken. So the sale value will only be 75 lakhs. The sale value will only be 75 lakhs. Okay, see, please understand, actual consideration 75 lakhs, stamp value on the date of agreement தான் எடுத்துக்கணும், because advance is paid through approved modes, so 75 lakhs. Okay, less cost of okay, stock, because this is stock 43CA. Okay, Harihara Prasad has purchased the property for 60 lakhs. Okay, and expenses of development, expenses of development, expenses of development 7 lakhs. Business profit, business profit 75 minus 67, 8 lakhs. Change a bit. Where advance is received by approved moves. The same for a property dealer, only I am working again. Okay, where advance is not received, not received, where advance is not received. Okay, what happens here? Okay, what happens here is something like this. Stamp value on the date of registration, on the date of registration, not okay, registration, since advance not received. So how much it comes to? 85 lakhs. It comes to 85 lakhs. Okay, here the conclusion is, since stamp value exceeds 110% of actual consideration, SV will be taken as sale consideration. So sale consideration will be 85 lakhs and the profit will be 18 lakhs.
Sir?
Raja?
Sir, in this question, for the cost of stock, wouldn't we have already claimed it in 1819?
Illa Raja, 1890 it would have only been a closing stock. Only when it is sold, it will become cost of sales.
Oh, okay, okay.
If Harihara Prasad is not a property dealer, then the provisions of section 50C will be applicable. Okay, same provision now. The change provisions of 50C will be applicable. Okay. One advantage while drafting the question, I wantedly drafted like this. It is a short-term gain. 19 purchased. It is sold in December 20 itself. It is sold in December 20 itself. Okay. It has been purchased in 2019. Okay. Right. The business profit mentioned above will be taxable as STCG in the hands of, okay, Hari. Okay, instead of taxing it as business profit, then indexation kadayadu, it's only STCG. Had it been more than 2 years, I would have indexed it, but the purpose is to make you understand, not to make you compute. Okay, so this would have been taxable as same 8 lakhs and 18 lakhs. Advance received, advance not received. Same 8 lakhs, 18 lakhs, but it will be taxable as STCG in the hand. So 43CA and 50C are mirror image provisions. If you are holding it as stock in trade, it is 43CA. If you are holding it as a capital asset, it is 50C. Okay, right? So that is one thing. What will be the impact if Ashwin has not paid? How will the, okay, compute the impact in the hands of buyer and the seller. Now in the hands of Ashwin. Okay, in the hands of Ashwin. Okay, what will be the hands of, okay, section 56 subsection 2 applicable. Okay, particulars. Okay, advance paid, advance not paid. Of course, approved modes only. Okay, advance paid, advance not paid. Okay, actual purchase price 75 lakhs in both the cases. Okay, stamp value on the date of agreement. Here it is 80 lakhs. Okay, stamp value on the date of registration. Okay, here it is 85 lakhs. Okay, 110% of actual purchase price. 110% of actual purchase price. Okay, 82 lakh 50,000. Please understand, inadequate consideration, difference between, okay, difference between stamp value and consideration paid, difference between stamp value and consideration paid. Okay, 5 lakhs, here it will be 10 lakhs. Okay, in this case, okay, such inadequate consideration not taxable, such inadequate consideration not taxable as SV has not exceeded 110%. Okay, in this case, my dear friends, the such inadequate consideration will not be taxable. Such inadequate consideration will not be taxable in this case. Why? Because even though it has exceeded 50,000, even though this has exceeded 50,000, it is not taxable because of the simple reason that stamp value has not exceeded. இதனால்தான் the 56(2) இந்த amendment carry ஆகுது. One amendment which has an impact on 3 different sections: 43CA, 50C, 56(2). Okay, because it has not. Whereas in this case, okay, entire 10 lakhs taxable as gift. Okay, the entire inadequate consideration. One, the reason is stamp value has exceeded 110%. Inadequate consideration has exceeded 50,000. The whole of the inadequate consideration becomes taxable.
Sir, this 10 lakhs is double taxed, right, sir?
Yes, sir. Yes, you are right. I have already covered the the amendment in IFOS, okay, which is for dividend and immovable property, that is 10%. So I have already covered this, okay. So I'm not going into specificalities of this, okay. In set of carry forward, there is only one thing, that is, now you all know that Yes Bank is merging. Okay, previously State Bank க்கு மாத்திரம் இந்த பொல்யூஷன், இப்போ வந்து there are many banks which are merged. Okay, previously it was only for State Bank, public sector banking company with a specified bank தான் இருந்தது. Now banks with another bank, this is the amendment. And government company with another government company, these two are the amendments. Okay, that is amalgamation losses. Normally industrial undertaking, ships, hotels, okay, State Bank and public, because public sector banks and other things only were, and Indian Airlines are India. Now they have opened up because Yes Bank, because of a couple of other banks, there are a lot of banks which are merging. So bank with another bank, and they have used it also for government company with another government company. Okay, let us take a small break. Okay, okay, the same person also told me in the 10 minutes break la engalukku poradhu. Okay, so time now in my this 7:45 or 7:47. I will meet you at 8:05. It's a 20-minute break. Okay, please come back at 8:05, and then we need to complete this deduction chapters and few other small areas. Okay, so that we can wake up fresh in the morning to start with TDS provisions. Okay, meet you in 20 minutes. All the very best.